Welcome back to Weekly. Joining me now to chat about real estate investing in North America is Andrew Moffs, Senior Vice President and Portfolio Manager at Vision Capital. Andrew, thanks for joining me on Weekly.
Thanks very much for having me.
A repeat performance. Great to have you back. So you're a seasoned real estate investor, and you run a $300 million long-short real estate fund at Vision Capital. What's your take on real estate investing at this point in the cycle?
Well, at this point in the cycle, we're certainly later in the innings. We've had a tremendous move in cap rates. The first year going in yield has compressed significantly since the financial crisis. But if you look at supply and demand characteristics by property type and geographic region, overall, they're still strong. So you have this conflict of many people thinking, hey, we're late in the cycle, what should be happening next? But at the same time, if you still have job growth and you have low new supply, you're probably in a good spot.
So over the last few years, falling interest rates were, rising tides lift all boats. Is that game now over, and so now you actually have to pick stocks?
We believe that. It is certainly a return to a stock picker's market, and you've seen it in the last year or two. You're starting to see dispersion by asset class. There's many themes we can talk about where you're starting to see lots of negative headlines in retail, positive headlines in industrial, residential, steady, and all that has to do with the fact that now you have to look forward and you have to say, okay, cap rate compression is done, and where are you going to see NOI growth?
So before we drill down to a few sectors, are there any broad statements that you can make about the health of Canadian real estate stocks versus U.S. real estate stocks?
Broadly speaking, you'll find we invest top down and bottom up. Top down, if you think about the macro, there's similar investment themes on both sides of the border, whether it's the aging population, demographics, whether it's the rise of the millennial and their propensity to rent versus own. Those are the same. What's different when you look in the public markets is how are these companies capitalized? How are they allocating capital? How are they distributing their capital to the investor base? What is their investor base asking of them? And this forces those management teams to make other decisions based on where their constituents are pushing them. So in the United States, you have what we call the REIT mafia. You have institutions that probably own north of 80% of these stocks, more sophisticated. Here in Canada, it's definitely focused more on the retail side, where they simply want that yield. That forces management teams to do different things. Those inefficiencies is something we take advantage of.
And when you look at the valuation of Canadian real estate stocks versus U.S. real estate stocks, and again, this is a broad statement as opposed to a sector-by-sector approach, but broadly speaking, are Canadian real estate stocks more expensive or less expensive than the U.S. ones?
We're net asset value investors. Value guys, we look at where are these stocks trading compared to net asset value. In the United States, they're back to very deep discounts. In Canada, arguably, a lot of these stocks are trading at premiums simply because investors continue to chase yield in this environment.
Right. And payout ratios tend to be higher in Canada than in the United States, based upon what you just said?
Absolutely.
Right.
I think we're a little unique at being total return investors. We almost are agnostic what the yield is. Sometimes a high yield is a red herring to say, hey, they're over distributing, and perhaps there's a cut coming, and that's why we have the ability to go short stocks and take advantage of that. But certainly we find here in Canada a lot of those companies are over distributing, especially when you take into account the significant capital expenditures these companies need to spend.
Okay, now let's drill down into the sector, and our viewers can see the dichotomy that you described earlier between how, for example, industrial REITs have done great year to date in the United States, whereas retail REITs have been a disaster. Let's deal with retail REITs at this point in time. What's your take on what's going on there?
Sure. I mean, every day there's a headline in the newspaper of another retailer going bankrupt, another department store closing down, stores, chains closing, et cetera. It's hard to get away from this. What has that done to the shopping center companies, the mall REITs? They've all traded off significantly, as you've alluded to. So now, where do we look? We look in the United States, we look at the top malls in the country, call it the Yorkdales of the world, to use a Toronto reference. We've centered it on a company called GGP, formerly known as General Growth Properties. They own the top malls in the country. They have malls doing over $700 per square foot in sales. That's very healthy in this environment.
Can you put that in context to one of the bigger and better malls, say in Vancouver, Calgary, Toronto?
Well, I mean, the best malls here in Canada will do north of $1,000 per square foot in sales. Same with GGP. They own the Ala Moana shopping center in Hawaii. That's the top 10 in the country, and that certainly does over $1,000 per square foot in sales. When you look at these retailers, when you look at department stores, it's not new news. They're all closing down. You look at GGP, they've gone from 500 department stores, they'll be at 200 department stores in a couple of years.
Wow.
But if you think about the bottom line, on average, these department stores are spending $1.50 in rent, and that's nothing. GGP can take over these spaces, bring elements to the mall that are lifestyle, whether it's restaurants, gyms, reasons for people to get out and shop as opposed to just simply stay at home and be online.
So in the United States, we have a long list of mall operators, mall REITs,
Yep.
and they've all been thrown out to the woodshed or taken out to the woodshed. But the B malls deserve to be, like the CBLs of the world,
Correct.
but the A malls, like the GGPs and the Simon Properties, don't. Is that
Right.
fair?
Well, exactly.
So you see an opportunity in getting long an A and maybe not being short anymore in the Bs, but not being long Bs.
At Vision, we simply want to capture that arbitrage of real estate trading cheaper on Wall Street than Main Street. If you went to market with an A mall today in the United States, it doesn't happen very much. You're talking about a 3 to 4% cap rate. I can buy GGP all day long at a 6% cap rate.
So the controlling shareholder of GGP today,
Yes.
Brookfield.
Yes.
So I want to show our viewers a ratio. So I take a share of Brookfield Properties, BPY on the New York Exchange, divided into the share price of GGP, and bottom line is it looks like it could be a good time for Brookfield to move and acquire the remainder of GGP.
Absolutely. I mean, one could come up with a theory that Brookfield, both the ultimate parent company, Brookfield Asset Management, and Brookfield Property Partners, have been going to this asset management model where they simply want to own the best real estate and garner fees on owning that real estate. When you own a public company, you don't get the fees that come with it. When you own the real estate privately with partners, then that's when fees begin to compound. So this is the perfect time for BPY to consolidate their GGP position if they're able to bring their partners in with them and raise the significant amount of capital that's necessary. But they certainly love this asset class and it'd be a shame for it to go away.
And what's GGP potentially worth?
Well, I don't even have to make a comment. You can just look at the IFRS values, and that's $29. A stock trading in the $23 to $24 range today, that's a lot of value.
Thanks very much, Andrew.
Thanks.
After the break, we're going to move on to the office market in Canada. You're watching Weekly on BNN, and I'm chatting real estate with Andrew Moffs of Vision Capital.